Welcome back to the Daily Hunt for Multibaggers, your go-to source for AI-generated insights into the wildest corners of the market. We're here on Wednesday, October 22nd, 2025, diving deep into all the market chatter and data collected yesterday, October 21st.
And what a day of data it was, Ethan. We saw a considerable number of posts flagging quite a diverse range of stocks. The overall sentiment, I'd say, was a real mixed bag, from wildly optimistic calls for growth to some seriously bearish warnings, especially after a few key earnings reports. So, a bit of everything for everyone today.
All right, let's jump right in. First up, we've got Nebius Group NV, NBIS. Now, the community sentiment here is overwhelmingly bullish, Brooke. Users are really dismissing that meme stock label, pointing to a massive $19 billion deal with Microsoft. They see it as a legitimate AI player and are keen on buying the dips, expecting strong long-term growth.
Well, Ethan, the community's conviction is certainly loud, but the numbers are telling a different story, NBIS has an extremely high PE ratio of 135, paired with a negative operating margin. This company is actually losing money on its core operations. Plus, its debt-to-equity ratio is high at 32.43. That's a huge disconnect between current fundamentals and market expectations. This is the definition of a speculative bet.
I hear you on the numbers, but the Microsoft deal is substantial, and users really believe it's going to drive that future profitability. They're holding for 3 to 5 years.
Perhaps, but relying purely on future potential when the present financials are this weak is a high-stakes game. Our previous ratings for NBIS have swung between speculative gamble and stay away. Given these current metrics, we're going to reaffirm that this is a stay away. The extreme valuation and unprofitability are just too much of a risk right now.
Okay, noted. Next up, we had some chatter around Oklo Inc., OKL. The initial post highlighted a huge past price increase, associating it with the bullish AI industry. Sounds like some past big wins,
That past performance is definitely noted, Ethan, but for new investment, it's a completely different picture. Oklo currently has zero net profit and zero operating margin, meaning it's unprofitable with negative earnings per share. Its price-to-book ratio is an extreme 29.55, implying a valuation based entirely on future hope, not current assets. Plus, we've seen news of significant institutional selling, like Cathie Wood offloading shares, and the stock is down about 28% from its 52-week high. Our previous ratings have mostly been stay away, though we did have a cautious buy recently. We're downgrading it back to a stay away today. There are just too many fundamental weaknesses and cautionary signals.
All right, moving on to something a little sweeter perhaps. Krispy Kreme Inc., DNUT. The community is buzzing with bullish sentiment here, talking about DNUT to the moon and the potential for a short squeeze. There's even talk of expanded distribution channels with Costco, which could be a big positive.
Well, that to-the-moon sentiment often accompanies meme stock dynamics, not necessarily solid fundamentals. The reality is, Krispy Kreme is deeply unprofitable across the board. Negative revenue growth, negative net profit margin, negative EPS, you name it. And get this, its debt-to-equity ratio is an astronomical 199. That's an extremely leveraged company that isn't making money. While the dividend yield of 4.29% might seem attractive, for an unprofitable company with that much debt, it's a huge red flag. This is a new one for us, and based on these deeply concerning KPIs, it's a firm stay away.
Wow, okay, that's a tough pill for the donut dreamers. Now let's talk about Rush Street Interactive Inc., RSI. We saw some lively discussion where users were actually quite bullish on the company, particularly in the context of the AI hype for chip companies and a big deal with OpenAI. It sounds like there's a lot of long-term confidence.
Ethan, this is where we have to be super careful with our data. While the user sentiment you're referring to was indeed bullish, that discussion was actually about AMD, not Rush Street International. The KPIs we have for RSI paint a very different picture. The company has an exceptionally high PE ratio of 89.38, and despite strong revenue growth, it has a negative operating margin, so it's not profitable from its core operations. Our data strongly suggests that this stock is overvalued relative to its current business health. This is a new stock for our coverage, and our AI-generated analysis strongly indicates a stay-away recommendation.
Understood. Crucial distinction there. Okay, next, Apple Inc., AAPL. The sentiment is very bullish here, Brooke, driven by continued innovation like the new Vision Pro with the M5 chip and positive analyst upgrades from Loop Capital, Wells Fargo, and Goldman Sachs. It seems like the iPhone growth cycle is alive and well, with the stock trading near its 52-week high.
You know, Ethan, it's hard to argue with Apple's consistent performance and innovation. While its PE and PB ratios are high, they're often justified by its exceptional financial health. We're looking at a fantastic 149% return on equity and a robust 24.3% net profit margin. The stock is near its 52-week high, signaling strong market confidence. We rated it a buy most recently, and based on these continued strong fundamentals and innovation, we're reaffirming that this is a buy.
And that makes sense. Sticking with the big names, let's discuss Tilray Brands Inc., TLRY. There's a cautiously bullish sentiment, especially around potential regulatory changes in the cannabis sector. Users are really excited about its diversification into beverages and hemp-infused foods, mentioning specific growth numbers in those areas.
Ethan, I appreciate the optimism, but my KPIs are waving red flags. While some users claim a strong balance sheet, Tilray's debt-to-equity ratio is an alarming 21.29. That's a highly leveraged company. And despite claims of double-digit growth in specific segments, its overall revenue growth is a modest 4.7. Most critically, the company is deeply unprofitable across the board, with a negative net profit margin of over 250%. Tilray has been a stay-away in our analysis consistently, and today, given these severe fundamental issues, we are maintaining our stay-away rating.
Okay, a tough outlook for Tilray. Now for Open Door Technologies, OPEN. The chatter was pretty light here, but it did refer to open investors as bag holders, waiting for a rebound, not exactly glowing.
No, it certainly wasn't, and the KPIs support that cautionary tone. Opendoor is unprofitable, with a negative net profit margin and EPS. Its debt-to-equity ratio is an extremely high 346.117, signaling massive financial leverage. On top of that, it has a very high beta of 3.596, meaning it's incredibly volatile. While it saw a significant surge from its 52-week low, it's now trending down from its high. Opendoor has been a consistent stay away in our reports, and we are reaffirming that today as a stay away.
Moving on to a tech giant, Alphabet Inc., GOOG. We had a couple of posts, both with strong bullish conviction. Users are excited about Google's moves in mixed reality and AI, calling recent dips the dumbest dip ever and a buying opportunity. There's real confidence in their fundamentals and AI leadership.
Ethan, the market sentiment for Google is definitely strong, acknowledging their innovation and profitability, with excellent net profit and operating margins and solid revenue growth. However, one of the analyses specifically flags an extremely high debt-to-equity ratio of 11.481. For a company of Google's stature, this is highly unusual and raises significant financial risk concerns according to our AI. Also, with an aggressive short-term options target and an earnings report just around the corner, that combination, coupled with that high debt figure, makes it a very risky bet in the short term. Despite previous buy ratings, this specific analysis of the KPIs provided today forces me to classify it as a stay away. The fundamental strength is there, but that debt metric is a huge red flag that overrides it in this analysis.
That's a surprising turn for Google, but we stick to the data. Next, Meta Platforms Inc., META. The sentiment is extremely bullish here. Users are highlighting Meta's advanced AI monetization strategies with over 1 billion monthly Meta AI users and the Quest 3 dominating the VR headset market. This sounds like strong growth in emerging tech.
Absolutely, Ethan. Meta's KPIs are truly impressive. We're looking at robust revenue growth of 21.6%, an excellent net profit margin of almost 40%, and strong earnings per share. The company is actively investing in AI infrastructure, and analysts like Bank of America are projecting significant revenue beats. The stock is currently trading strong near its 52-week high. Meta has been a buy in our recent reports, and with these continued strong indicators, we are very comfortable reaffirming our buy recommendation.
Great to hear. Let's talk about NVIDIA Corporation, NVDA. This one also had conflicting sentiment. On one hand, there's immense bullishness around its leadership in AI supercomputing, like the DGX Spark, with endorsements from figures like Elon Musk. Incredible revenue growth, profit margins, and return on equity. On the other hand, we saw posts with users feeling cooked and fucked from recent losses.
You're right, Ethan. It's a tale of two NVIDIAs in our data today. While the fundamentals are undeniably stellar, exceptional revenue growth, profit margins, and return on equity, the very high price-to-earnings ratio of 51.61 and a beta of 2.123 point to significant volatility. That high valuation means any short-term dips are amplified, leading to that user angst. The stock is also below its 52-week high. Our AI has flagged it as a cautious buy recently, and given this blend of strong long-term potential but high short-term risk and premium valuation, we're sticking with a cautious buy. It's for investors with a high tolerance for volatility who believe in the long game.
Good call on the caution there. Now for Applied Digital Corporation, APLD. We saw some cautiously bullish sentiment with users buying back on the dump, citing their strategic shift into the data center industry and partnerships like CoreWeave. There's definitely a belief in its growth trajectory.
Growth trajectory, yes, Ethan, but at what cost? Applied Digital has an exceptionally high revenue growth, which is good. However, it's deeply unprofitable, with a negative net profit margin of over 140% and negative EPS. Its beta is an astronomical 6.592, indicating extreme volatility. This stock will move wildly with the market. When you combine that with a high price-to-book ratio and negative return on equity, it suggests a highly speculative valuation unsupported by current profitability. APLD has consistently been a stay-away or speculative gamble for us, and today it remains a clear stay-away.
Wow, that's a lot of red for APLD. Okay, finally for our individual stock breakdown, Netflix and LFX. The sentiment here, especially after their Q3 earnings, is decidedly bearish. Posts like "congrats on losing everything" and calls for it to go sub $1,000 soon are pretty stark.
The market definitely reacted negatively, Ethan. Despite what seems like healthy revenue and net profit margins, Netflix lagged estimates for Q3 earnings, which led to the stock dropping post-announcement. With a very high price-to-earnings ratio of 52.91, the market expects exceptional performance. Missing those expectations, even slightly, impacts a stock valued so highly, and it's currently well below its 52-week high. This is a new stock for our coverage, and given the high valuation and recent earnings miss, our AI-generated analysis suggests a stay away.
And last but not least, Beyond Meat Inc., BYND. We saw users cheering a recent run in the stock with talk of meme stock madness and holding on to shares. There's clear speculative interest here.
Ethan, the meme stock madness is certainly driving short-term price action, but the fundamentals for Beyond Meat are alarming. It's deeply unprofitable, with a negative net profit margin of over 50% and declining revenue. Most concerningly, it has a negative price-to-book ratio, meaning its liabilities exceed their assets. That's a huge financial distress signal. Despite the recent speculative rally, our AI flags this as a highly risky proposition. This is a new stock for our coverage, and based on these severe financial weaknesses, it's a definite stay away.
Investigate as buy Apple Inc., AAPL, Meta Platforms Inc., META, investigate as cautious buy, NVIDIA Corporation, NVDA, Amazon.com, AMZen, investigate as speculative gamble, Nebius Group Incorporated, NBIS.
And that wraps up another episode of The Daily Hunt for Multibaggers.
Before we go, a quick word to all our listeners.
This podcast is for informational and entertainment purposes only. The content is generated by artificial intelligence and does not constitute financial advice. Listeners should conduct their own research or consult a licensed financial advisor before making investment decisions. We are not responsible for any losses incurred. The market is a wild place, and knowledge is your best asset.
Absolutely. Thanks for tuning in, and we'll catch you next time on The Daily Hunt for Multi-Baggers.